Of course, that greater than the 7% level that triggers the level 1 circuit breaker.
Retail sales down.
Oh my God, look at this. All right, retail sales year to date minus 20%.
Unemployment up.
4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
Well, good afternoon, everyone. I am Jason Kelly, live from Bloomberg headquarters here in New York. So happy to be with you. I am the host of Bloomberg Business Week and also the New York Bureau Chief. We're so excited to have you here with us. We're going to take a look at the global economic and financial challenges facing investors as they navigate this current environment, and what an environment it is. I'd like to start by thanking Invesco QQQ, our founding U.S. sponsor, for helping make possible this global event. You can check out more about Invesco QQQ in the resources section of our event platform. Before we get to the program, though, a few housekeeping notes. Make sure you're using Firefox or Chrome to view our sessions. If you have any trouble, here's an easy fix. Just refresh your browser. You can restore Windows using the buttons along the bottom of your screen and the size of each window. It's adjustable. Listen, this is the world we're living in. It's all virtual, and we're bringing you this fantastic program. It's also interactive, though. Just because we're not together doesn't mean you can't be a part of the conversation. We welcome your questions. To submit one, just type it into the Q&A box, and they will get it to me. Please include your first name and your city when you're asking a question. We're also going to be taking live poll questions. You will see those pop up on your screen as we're talking. Take a moment to register your responses. We're going to have a poll question for you at the end of the first session. And please engage with us on Twitter. I'm at Jason Kelly News. The hashtag for this event is Bloomberg Invest. Well, to help set the stage for today's conversations, I'd like to welcome Christina Hooper. She is the Chief Global Market Strategist for Invesco US.
Hello and good afternoon. I'm Christina Hooper, Chief Global Market Strategist at Invesco. Thank you for joining us at Bloomberg Live Invest. Over the next 3 days, Invesco QQQ will set the stage for the next hour of programming by sharing our unique insights and perspective on weathering market turbulence in COVID-19. In just a few moments, you'll be getting an economic outlook from Steve Schwarzman and others. But before you dive into the macro view, I'd like to share with you our thoughts on the U.S. economy. I believe that the shape of the economic recovery in large part will be dictated by two key factors. One, whether or not we get ongoing fiscal stimulus, and number two, whether or not we are able to tamp down any resurgences in the virus. So let's start with fiscal stimulus. If you look at the first chart, what you see is that the United States has provided ample fiscal stimulus thus far, especially direct fiscal stimulus as compared to other countries as a percentage of GDP. But it would be a mistake to assume that that is enough. even though we've gotten some very positive economic data of late, including the May jobs report and May retail sales. If you dive down into the May jobs report, what you see is jobs created, some by the reopening of the economy, but some clearly as a result of fiscal stimulus programs such as PPP, which are very short-lived. In addition, the May jobs report shows a significant loss in government jobs. And that's actually a continuation of what we saw in April. In total, for those 2 months, more than 1 million government jobs have been lost. And that should be no surprise given that state and local governments are under tremendous pressure. And some have balanced budget requirements. So we should expect, if they don't get any more funding, we should expect the hemorrhaging of government jobs to continue. I also think it's important to point out that American households, a large cohort of them, are financially fragile. A recent Fed survey showed that 37% of American households would not be able to meet a $400 unanticipated expense with savings. They would have to sell something or borrow in order to pay that expense. And that's very concerning given the kind of dramatic unemployment we've seen as a result of this pandemic. So fiscal stimulus is absolutely necessary. On the docket, up for consideration by the Senate, is the HEROES Act. This has been passed by the House. Now, it's largely viewed as a Democratic wish list, but I do believe if you look at this HEROES Act slide, you'll see the components of this proposed legislation. And some are important and worthy of consideration and really being passed, including that state and local government funding, as well as assistance for households hit by this virus, including ongoing benefits. That's going to be critical. Of course, the second factor that will impact the shape of the economic recovery is our ability to control any kind of resurgence in the virus. And that actually requires a contact tracing infrastructure that is substantial. And we can look to South Korea as the gold standard for that in terms of having an extensive contact tracing infrastructure that has enabled it to tamp down rather quickly a resurgence in the virus in early May. If we're not able to effectively do that, we could see the reimposition of lockdowns. And of course, we could also see an erosion in consumer confidence, all of which would be very bad for economic activity. I'm optimistic that with innovation and cooperation, we'll ultimately find effective therapies and a vaccine for this. But until then, having that contact tracing infrastructure is critical. Well, thank you again for attending, and I hope you enjoy the rest of the day's conversations.
All right. Well, Christina, thank you so much. Well, let's get on to it because I am so excited to kick this all off with a guy that I've known for quite some time. He is the chairman, the co-founder, the CEO of the Blackstone Group, Steve Schwarzman, joining me. Steve, how are you?
I'm fine. Jason, it's good to see you today.
I know, it's great to see you. You look great. I feel like, if nothing else, this is a different world because you and I are sitting here talking to each other, not wearing ties. We're not in the same place. Tell me a little bit before I start asking you all sorts of questions about the investment environment. How has this all been for you?
Well, this has been a pretty remarkable environment. Imagine, sort of around last year end, if somebody told you that we were going to have the voluntary closing of the world's economy, with certain exceptions to just keep food moving and other things, you would say something like that couldn't happen. And if it did, it would result in a global depression. And it just wasn't on the page. And in effect, those directions to almost every country to stop your economy did occur. And unemployment has gone up massively. but we haven't had a depression. And the reason for that is that we've learned from the past, and you've had massive government intervention, massive transfers of trillions of dollars of monies to people who need it to, in effect, replace the lost revenue from shutting our economies. And that first big stimulus bill in the United States, followed by really very, very large follow-on by the central bank in the United States, the Fed, is pumping unprecedented peacetime monies into economies. And in fact, the amount of deposits in banks, because money was transferred to people, has exploded. And so we are awash with liquidity that was necessary. To give you some idea, U.S. GDP is around $21 billion, trillion dollars a year, and say we miss a quarter or more. So we're sort of missing 6 trillion coming in, and somebody's got to fill that hole, and that's what all these stimulus bills and the Fed, in effect, are doing in a very simple way. And so we've had this dramatic collapse. Stock market's down 34, and now it's bounced up as if nothing had occurred because of the liquidity and support from the Fed, and also
so let me ask you about that. So Steve, if I may, that specific point is one that I really feel like I want to understand from your perspective, which is this apparent disconnect with every headline that we're reading every day related to virus cases going up, this medical crisis, this health crisis that we're going through, and a stock market, if I even just look at my own 401k, that has rebounded. Is it just basically the liquidity that's been pumped into the system? Help me understand this gap.
Yeah, I think it's mostly the liquidity that's in the system, and also some elements of confidence. In other words, you have 130 vaccines that are in the process of development. The fact that we'll go 0 for 130 really seems remote. There are 3 different types of vaccines, and so I think people are much more optimistic that's going to occur on a time frame that's way different than the development of vaccines was in the past, where the fastest one was like 4.5 years, and people have optimism that within the next 9 months we'll have enough positive, could be a year, outcomes from trials that you'll get there within a year to start really producing large-scale vaccine. And there's other therapeutic breakthroughs that are occurring if you get the virus. The second thing I'd say about these cases going up, how could one believe they wouldn't? I don't find that surprising. People have been locked up in their homes for 2 to 3 months. And when you let them out, there'll be more socialization, and people won't understand truly that this can get them sick. And once they see that, and the appropriate government response will be to first really warn people. In democracies, apparently, they like to see bad things happen before people in democracies actually respond. So I completely expected this to happen. I think the markets did as well, and that will be put under better control because there's no option. Nobody really wants to get sick, and so you'll have change in behavior as the number of cases goes up, and eventually that'll be beaten down. But I think you'll also see a big V in terms of the economy going up for the next few months because it's been closed. And as people are allowed to go back, the economy will really respond a lot. But there's only so much the economy that's highly complex can respond. just because not all things go up equally, and it will take quite a while before we sync up and get back to 2019 levels.
So, Steve, when I think about your experience, I know that Blackstone is a place where you're always looking at opportunities and new opportunities in many ways. I think back to the turn of this century and the big bet and a lot of investment you made in real estate. I think about the last financial crisis and how heavily you invested into credit and distress through GSO and other means. What's something that you're doing now? Take us inside Blackstone that might help us understand the opportunities that exist in this latest crisis.
Yeah, well, this one's different. They're always different. And, you know, the easy things to have been doing was, you know, when you hit that bottom, even if you didn't know it was the bottom, to be making significant investments. We reported just at the end of the first quarter that we'd invested $11 billion in effect liquid securities. And that's, of course, had a very happy outcome. And you know, we did more in addition to that. And that's sort of a first stage. I think each of our businesses are now seeing interesting opportunities. And you know, as technology is changing things and people are staying home more, the areas where you'd want to invest, whether it's technology or healthcare, are being modified. Certain older economies that are bound to be disrupted, those types of companies are places where, unless you have a really remarkable management, you'd be wanting to stay away from. We can see different parts of the economy opening faster. Some things were closed completely. Interestingly, in the hotel business, we owned one hotel in Las Vegas, completely closed. The first weekend it opened, it was 45% filled. That's an astonishing thing because Las Vegas was barely open. So there will be some surprises, not all hotels, but as you look at the gradation, places where you can drive will recover much faster. Places where you have to fly will recover much slower. And if you have to fly over oceans, those will be the slowest recovering types of investments. So each of our businesses is starting to really put out money, our business lines, and there's a much better tone. To do a lot of private investing, there has to be some confidence on both sides. Sellers have to believe they're getting fair value, and the people who are buying think they're getting fair value. So there's an overlap. Typically what happens, as you know, Jason, if you're doing private investing, that sellers don't like to sell at bottoms. You can buy liquid securities, you can buy debt securities of CMBS and other things that are stacks where you can, you know, find the security where you think it has the most upside, even if it's gone up halfway from where it started. Some of these will continue to go up, and others have already returned to par. So it's an issue of figuring out which of the underlying businesses are going to return to health. We're taking a basic view that it's not particularly interesting to buy securities in what are really challenged businesses, challenged business models. And those things trade at very deep discounts. And if those companies make it, you know, that's a good thing. But the chance that some of these will recover as nicely as you want is perhaps compromised in this cycle because of the impact of technology and change behavior of people. We've made a huge amount of money continuing to build our warehouse platform. We're either the largest in the world or the second. We We bought about 1 billion square feet of warehouses. Why did we do that over the last 10 years? Because we saw the online business exploding, and we saw concomitantly that regular retail was going to get really hurt as consumer changed. The pandemic has accelerated trends that might have taken 5 years and made it happen in 3 months. And so we're very mindful of these types of changes, and are investing around those type of those changes.
So, Steve, when you think about how Wall Street may change out of this, it clearly changed after the financial crisis, and candidly, Blackstone was a big beneficiary of that. Your business grew at an enormous rate. How does the investing world, how does Wall Street change on the back of this particular crisis, in your estimation?
Well, it's interesting. I mean, if you take the different parts of Wall Street, take the banking community. I think the banking community went into this crisis very strong, and they're going to come out strong. And so that's a big change from the last financial crisis. In the money management area, I think that the index fund business will continue to gain share because it's not been bad at all to be long equities. And by the same token, the alternative class will also continue to attract a lot of money. The long-only managers in the middle were sort of disadvantaged. I think their performance will end up being better than people thought. So there'll be a little more stability, but the basic trends of index funds and alternatives will continue. I don't think you'll see that many mergers in the money management area, and the brokerage area has pretty well been consolidated. So I don't think there are going to be enormous changes coming out of that. You'll continue to see more and more money being managed using quantitative techniques. It's already up to around a third. It could go a little higher.
So what do you do? And do you expand? I mean, you've expanded in every downturn pretty meaningfully. Are you looking for things to buy at this point? Are you looking for other businesses to expand into at Blackstone?
Well, we've set some seeds for expansion before we went into this, because we thought we knew where the world would present opportunity. And one of those areas is in life sciences. And we just finished raising, or about to finish, a life science fund, and that kind of focus of the world with all the vaccine, and everyone's now an amateur expert in sort of COVID and what we have to do for the future. So that whole healthcare business is going to really grow, and growth equities, the use of technology and rapidly growing companies is going to do very well, we believe, and we're raising a pool for that. And we'll see what comes out of this crisis. One of the things about starting new business, which I guess we've done in the financial area about as much as anybody, is you have to see what starts occurring. Some of these trends you just can't miss, and how you play them is what's to be determined. At the moment, we're quite well placed, but it's almost like you can't find enough of disruptor types of technologies and applications of those for people, and fintech, and a variety of things that take advantage of this kind of change world is where one has to move. I'll tell you one other thing that we've learned, which is that the quality of management at a time of disruption is more key than it ever was. If you have relatively stable positions in markets and products, your management could be good, not great, and life will go on because you're either patent protected or process protected. But in a world where everything appears to be challenged, whether you're the disruptor or the disrupted, the quality of the people managing that change, reacting to that change, takes a completely different amount of importance. And you know, we're going to pay even more attention because great managers can create great results, and okay managers, which used to be okay, will not have okay results.
I read in a book that came out last year that you only hire A players, right? Didn't I read that somewhere? Some book that I read?
Yeah, I read that book too. The difference is I read about 30 drafts of it, as opposed to you just having the good luck of reading one draft.
Exactly.
You know, that turned out to be a bestseller. It's called What It Takes, and you know, I wrote it, and you know, it was the #1 book in China as well. So and you know, I just got contacted by the Mongolia market, you know, and all over the world. So it's been a very interesting adventure for me.
I always said you were going to be huge in Mongolia, Steve. It was a very good book, and I'm glad you got to plug it here. I'm sure the paperback is coming out soon. Well, you talked about China, so you gave me an opening. You demonstrated in that book that you know as much about China as any modern businessman. I'll say that so you don't have to, as a philanthropist, as someone who has intimate knowledge of the market and the key players. Given everything that's going on in the world right now, not just virus related, geopolitical, geoeconomic, how much should we be worried about a decoupling with China?
Well, I think this decoupling that is going on is a very unique situation. I mean, the U.S. and China together, depending upon who's doing which measurement, are about 40% of the global economy. Now, imagine that. There are over 200 countries, and 2 of them are close to 40%. This is stunning. And there will be changes, some of which, you know, would be expected when you have some element of geopolitical rivalry. And now with COVID, which is the first time that borders have really been closed around the world, businesses and to some degree governments are concerned about supply chains. Because there's been a huge concentration of supply chains in China because they're so good at manufacturing and so quick in terms of the ability to establish those effective supply lines that a number of companies, when they couldn't get supply, just simply by the nature of China being closed, and then subsequently every other country in the world closing its borders, that this is a scary type of prospect for business people, and I think they'll respond to some degree to diversify supply chains, and that will be normal. Some verticals, some areas, whether it's pharma or whatever, healthcare will have more focus on those types of changes. But meanwhile, I think what will happen is China will, with its 1.4 billion people, will continue to grow because they will internalize their markets. And you can do that at that scale and depend less on exports. And I think China will continue to grow at double or triple the rate of the developed Western countries, but the mix will be different.
Does that worry you about growth in the United States then, just taking it as a whole?
Well, I think for the U.S. We have a lot of advantages on our own. We'll get some more internalization. We'll lose some exports through that process. We have super low interest rates. We're running massive deficits. We're doing everything we can to promote growth. So I'm not worried about U.S. growth in particular on a longer term basis. One of the most important things that people don't think about so much is the quality of our education. And we have great universities, but as a country, for the last several decades, we've underperformed in the primary and secondary area of schooling. And I think we need to have a refocus because this is what provides the underpinning in the post-industrial age for vibrant economies.
So, Steve, I do want to talk briefly about sort of the other crisis that we're facing, which is one of racial injustice and a lot of the social unrest that came in the wake of the killing of George Floyd, and the aftermath of that and all the discussions that we're having about what we do next. One of the interesting theories that I've heard from a number of big investors is that private equity has the ability, given its vast influence over big chunks of the economy, and you and I have talked a lot about this before, the knowledge that you have, the relationships with CEOs and the control or the influence over a lot of companies. What's private equity's general and broad role in maybe trying to fix some of the ills that have been so clearly laid bare in the last month or so?
Now, I think this is a broader societal issue than private equity, of course, and the sort of killing of on television was so upsetting to so many people that it's triggered this relooking at equity in a variety of areas, and I think everyone wants to do something to rebalance the society and the opportunities. And in our firm, for example, we've already had what we call affinity groups for women, for veterans, for LGBT people, for our Black employees. Each one's a separate group, but anybody at the firm can join any group they want, regardless of whether they have the exact qualifications for that group. And as we look at things, we turn to our groups and say, what can we do better? How can we help this situation to rebalance? And I think that we're also looking at our portfolio companies and seeing what we can do. And I think, as you mentioned, Jason, this is a good area, and so this whole moment in time is sort of creating a productive reevaluation of things. And I think everyone in society would like to make sure that the promise of equality of opportunity and should be equality of preparation occurs.
So, Steve, as you think about, with all the conversations that you have with your peers, portfolio companies, heads of state, I do wonder what sticks on the other side of this, of these dual crises that we continue to live through in terms of the way companies operate, the way decisions get made. You mentioned earlier in the conversation that this is a real test for managers to sort of weed out who's really good at this. I do wonder, and maybe this is even for yourself, what's different on the other side when we get to the next normal, as it were?
Well, we've certainly been through a test. It's a test for society. You know, I still find it astonishing that you manage to have the vast majority of people around the world sort of go into suspension for 2 to 3 months. And so there's going to be all kinds of changes that come out of that, and changes in some values, changes in how work is done, how people relate to each other, that the way they choose to have quality time, and even just sort of being in shape. Some people like myself, you have more time. I spend more time in the gym and changed what I'm eating. I've given up profiteroles and all kinds of wonderful things, and now I'm in much better shape. Some people, went the other way and bulked up. For example, it's hard to imagine, but I was watching a TV show at night, and the journalist reported that purchases of alcohol in the United States went up 455% in 1 month. So we're going to have a lot of things to undo. We're going to work to find a new normal. And for people, we just had a graduation of this program I have in China called the Schwarzman Scholars, and we told the students that they're going through an unprecedented time of high unemployment and this impact of COVID, and in a way, and I said this to our people who were younger at the firm, that they're going to be lucky. And the reason they're going to be lucky is their world at the start isn't going to be so good. And they're going to find a way to make it work, because there's always a way to make it work. And for their lives, they'll always be more wary and more clever than the people who started at a time where everything went well. And so our job is to help each cohort, if you will, of society adjust to this. And adjustments there will be. And we're not into a regular way world now. And when we come out of this, 2 years, 3 years, everyone will be affected. And they'll carry those lessons learned into the future.
All right. Well, Steve, it's really good to see you. I look forward to seeing you in person before too long. Best to you and your family. Always good to get your insights. Steve Schwarzman, the co-founder, chairman, and CEO, of course, of Blackstone. All right. Well, following up on that, we'd like to hear from you on this. We've got a poll question. We're going to do a quick poll. What's next for U.S.-China trade? We heard a little bit about China and Steve Schwarzman's view of it. Here are your choices. Phase 1 of the trade deal will move ahead. The parameters of the trade deal will be changed and agreed. The U.S. will pull out of the trade deal, or China will pull out of the trade deal. And while we wait for those results to come in, we're going to move on to our next session in just a minute. I'm Jason Kelly from New York.
At the end of 2017, we decided to take a hard look at the actual numbers, both in terms of our representation and our stories, but also on our TV programming and our radio programming. And the numbers really surprised us. About 10% of our outside guests that were brought onto TV were women.
I think we all can agree that the industry would be far better off for being more diverse.
What we heard from the bookers was that either they said that they couldn't find the women, there weren't women in the right roles that they were looking for, or if they found the woman didn't feel comfortable going on TV. And we thought the one thing that we could actually impact was this issue of the training. And we created an initiative called New Voices in 2018 to offer 4-hour one-on-one training for each woman that we brought in to give them some video experience, some feedback, to learn about their messaging.
This is what I would say. I think quarterly earnings, we all get extremely focused on. It's a really good training. And what I really learn is just understanding sometimes you may not want to answer that question and just being able to pivot to something else entirely and getting your point across.
Something that really impressed me about this initiative is that it is without any expectation and the program is fully confidential.
It's not necessary to go on Bloomberg TV after this. The idea is that you will be TV ready to voice your opinions, to share your perspective. The ultimate goal from a journalistic standpoint is that we have better programming, that we have more interesting conversations at events and hearing opinions that we may not otherwise have voiced.
The only way to really achieve those goals is to have that representation within the financial news.
So we've more than doubled the percentage of women experts on our TV and radio to over 21%.
Why do you think tech executives are putting their money and their muscle behind this now? I see the difference when we have more female voices on our show. There are new ideas, new insights.
Anyone really who's looking to grow professionally in their career is a fantastic opportunity to take up.
All right, good afternoon, everyone. I'm Scarlett Fu, an anchor here at Bloomberg Television in New York. Let's check the results of the poll for the question that Jason just asked. The question is, what is going to happen next with U.S.-China trade relations? What is next? And the response so far, 47% believe the parameters of the trade deal will be changed and agreed upon. 29% believe phase one of the trade deal will move ahead. Meantime, 15% believe the U.S. will pull out, while 7% believe China will pull out of the trade deal. Now, with that, I want to bring in our next speaker, Jim Chanos. He is founder and managing partner of Kinnikos Associates. He is one of the market's best-known short sellers, famed for his ability to sniff out financial fraud. Jim, great to speak with you. Thanks for taking the time today. Let's go big picture here and lay out the scene, because we have a stock market that is supported by stimulus galore. There's more likely to come. The Federal Reserve, of course, has put a floor under the credit market with its corporate bond purchases. So any company, it seems like, can raise funding. There's a new wave of retail investors plowing into equities. Their motto is stocks only go up, and they haven't really been proven wrong. What kind of environment does that create for short sellers like yourself?
Well, first of all, thanks, Bloomberg, and thanks, Scarlett, for having me. It's great to be here. Well, obviously, it's an environment that has gotten very, very speculative before the COVID sell-off. We were telling clients that beginning in November, right on through February, the market had taken a really speculative leg up, the likes of which we hadn't seen since, dare I say, late 99, first couple of months of 2000. And what made it different was it appeared for the first time in this 10-year bull market that retail investors began speculating more aggressively in individual names. And people have pointed to the Robinhood effect and zero commissions, and I know there's a debate about that, but it was unquestionable in our minds and in what we were seeing that the speculative fever kicked up a few notches in the fourth quarter of 2019, first couple months of 2020. The COVID sell-off in March really punctured that for all of about 3 weeks, and it's come back with a vengeance in many cases. And in many cases, stocks are trading meaningfully above where they were in January, February, in our little corner of the world. So I think that the massive central bank liquidity injections have certainly emboldened investors to feel that the Fed has their back, if you will.
I like that word, that term, emboldened investors. And just to be clear, Kinnikos benefit short opportunities, but also long.
I'm losing you.
You were saying, Jim? Sorry.
Could you repeat the question? I lost your audio.
Oh, okay, sorry. I was just getting to Wirecard. It was a long build up to Wirecard here, but this is a former European tech star, but now feels like it's a national embarrassment for Germany because a quarter of its balance sheet has gone missing, $2.1 billion unaccounted for. Is there a corporate fraud going on here, or is this something more mundane, like an over-leveraged balance sheet, a business model that's flawed?
Well, we think the evidence has been piling up. This was our largest position in our global short accounts and global hedged accounts. And we think the evidence was almost irrefutable by late last year that something was very wrong here. And management statements about the delayed audits increasingly seemed to be at odds with what we were actually hearing and seeing. The fact that the $2.1 billion, 1.9 billion euros at first went missing and now appears to have never been there was always our belief that, in fact, this company probably was never profitable. And I would guess that the senior executives may need some questioning, shall we say, on that account. This is kind of an amazing story. This company had all kinds of signs reported by media going back a year or two now, with evidence presented, and yet people still gave the company the benefit of the doubt over and over and over again till they could hide it no longer with the delay of the Ernst & Young audit. It's really kind of an amazing case study, if you will, and I guess I have a feeling I'll be teaching it in my History of Financial Fraudcast as one of my future cases. Let's put it that way.
Always new examples to add to that class curriculum. I wonder, though, whether Wirecard or any of the other companies that you're keeping an eye on here was using pro forma metrics, because I know that's something that you see as a common theme with a lot of companies that you're skeptical on, especially companies maybe from the Silicon Valley that have to do with the gig economy.
Right. So actually, Wirecard did not really abuse the pro forma metrics that we've talked about over the past couple of years. They actually, it just appears to be something much more basic than that. But having said that, I do think that one of the real abuses that's going on right now is the use by companies of their own devised metrics to tell investors, well, we're not really losing money. You see, if you add back all these expenses, we're actually profitable. And it's one thing to add back depreciation and amortization for some companies, although for most companies that's a real expense as well. It's another thing to add back compensation, which a lot of tech companies do because they pay it in stock. And we could go right down the list. I mean, there's all kinds of things I suspect that'll be added to the add backs in this year in particular because of COVID. But increasingly, companies are devising their own metrics, and I think it's one place where the regulators, could do a better job at forcing companies to really adhere to GAAP and not their own made-up numbers.
Right. Well, some companies get stopped before they can actually come to market, like WeWork and the community-adjusted EBITDA. Jim, I want to talk about one of your most famous calls, which is Tesla. You've been publicly short since fall of 2015, and the problems and problematic behavior of Elon Musk are well documented, but if you look at the stock, it's quadrupled since the past year and is now above $1,000. And it keeps trading like a growthy tech startup rather than a car manufacturer. First of all, are you still max short Tesla? And is there anything that would make you consider throwing the towel on this short?
We are still short Tesla. I think that you put your finger on it. I mean, the market is saying this is a tech company. I put out a spreadsheet every quarter comparing Tesla to all the other auto OEMs, and what's shocking is just how much it looks like another auto OEM. Almost the exact same margins, returns on capital. It's a tough business. Tesla's revenues have been roughly this quarter will be roughly flat for the last 6 quarters. So even the growth story, I know people are counting on all kinds of growth going forward. But the fact of the matter is the company's rate of growth has slowed dramatically. And in North America, we think they peaked out in terms of auto shipments last year and are doing so in Europe this year. China's still the growth area for them. But look, I mean, this is a company trading now at almost a $200 billion total enterprise value. So it's trading at 8 times revenues. Most of the other automakers trade between 1/4 and 1/2 of revenues. So this is really totally a perception by the market that there's some cutting edge technology here. The problem is that what everyone's excited about, whether it's batteries or autonomy, Tesla's not a market leader. Panasonic makes its batteries. The new super batteries out of China are made by a company called CATL. Audi in its A8 actually had level 3 autonomy, while Tesla's still at level 2. And as everyone's seen the videos sadly, of Tesla still slamming into to parked or overturned semi-trucks. I mean, it's quite something. So this company, I think, is a wonderful barometer of where people's views are on companies and speculation, because people see Tesla how they want to see it. And I think the product of Tesla that's always been first rate has been the narrative.
Okay, so to be clear, you don't necessarily see fraud going on here. There might be some accounting irregularities, perhaps, in the way that Tesla calculates things. I mean, that's something David Einhorn, another short seller, has pointed out. He talks about the accounts receivable at the end of the first quarter. But do you think there's fraud going on here at Tesla?
We have plenty of questions about the numbers. We have plenty of questions about management's veracity. All you need to do is go back to the Solar City acquisition and see how they justified it, and then what came out legally after that. I could go on and on and on. The offer, the bid. It's a company where we've seen a revolving door of executives. That's continued. Chief counsels come and go quickly. Let's just say, I think that the accounting side of the story is important, but the extreme valuation relative to the reality is just as important.
So if that's the case, Jim, why didn't the risk off in March do further damage to Tesla and other companies that you have a short thesis on? If the crash didn't take them out, what would take them out? I mean, what is it that's going to be the catalyst that leads to Elon Musk getting his comeuppance?
Well, I will remind you, Scarlett, the stock went from 960 to 360 during that period.
Fair, but
it's the rebound that's been just as strong, but the stock went down much more than the market did.
Okay, and you're still maximum short on it.
We're still short the stock, yes.
Okay, let's talk about electric truck maker Nikola. It listed this month, no revenue right now, and there are hopes that it will be like a Tesla disruptor in the future. In fact, the founder, Trevor Milton, often comes off like Elon Musk 2.0. Do you have a position, and if not, what would make you consider taking a position in it?
We don't have a position currently in Nikola, but I'm a little amused that it's taken this long. Given that Tesla's been so successful in selling a narrative, I'm actually shocked that it took this long for someone else to figure that out and come out and try to sell a narrative. So let's leave it at that.
All right. Well, the narrative is always key here. And another transport name that you are short on is Localiza. It's called the Hertz of Brazil, in essence. Yeah. You see a lot of parallels between Localiza and Hertz, especially from a couple of years ago. Explain your thesis here.
So we were short Hertz. We've been short Hertz for the last few years. We covered it right before the bankruptcy. I had publicly said I didn't think they were going to survive the next recession, and they didn't. But in doing our work and looking at rental car companies around the world, we were struck by one in particular that seems to be going down the same road that Hertz went down, no pun intended, from a couple years ago. And what got Hertz in trouble a few years ago was, despite the fact of its meager to no profitability, it was expanding its balance sheet much faster than its revenues and cash flow. So every incremental car was actually, bringing them less in terms of cash flow and profits. And ultimately, we figured that was going to catch up to them. Well, one of the largest rental car companies in Brazil, Localiza, is doing the same exact thing. It's basically growing its balance sheet and its capital multiples more than its revenue and cash flow. And it's borrowing to do it. And despite that, the company is trading at 40 times next year's earnings, 17 times EBITDA, which, anything about car rental companies, you'll know how absurd that is. But more importantly, its marginal return on capital is going through the floor. And on top of that, a huge chunk of their rental car customers are Uber drivers, who are not exactly the greatest credits in the world, particularly in Brazil. And so all of these things, the car rental business is not a lot different around the globe. It's a pretty similar business model. And if you look at Localiza, in their attempt to try to take market share, they're growing their balance sheet so fast relative to cash flow. We think that's going to be a problem down the road.
Let's go from Brazil to your favorite country, which is China. The debt keeps multiplying there. We know that U.S.-China relations are only worsening right now, no matter who enters or stays in the White House in November. You are short some large Chinese banks. Explain how this is going to play out when Beijing is going to be the backstop for its financial system in the same way that the Federal Reserve is the backstop for U.S. SIFIs.
So China is interesting. It's kind of come off the front financial pages, with COVID and the trade war issues. And I heard Steve Schwarzman, before discussing it as well. And what's constant about China is the debt situation. It just keeps going up. And this has actually put a damper on Chinese equity returns over the past 10 years. I always point out when we got bearish on China, the FXI, which is the large cap China ETF, was about $40, and I think it's right around there now. It's gone nowhere in 10 years. And I think that part of the problem is that in terms of the large cap Chinese companies, and everybody knows a high tech company or two that has done well, but in terms of large state-owned enterprises, they're just not very economic, and that goes for the banks. And so China is going to still have this debt situation it has to grapple with. Residential real estate is still a monstrous part of the economy. And basically, it's the same old, same old. And the problem for investors is the same old keeps yielding very mundane returns to equity holders. It's just not been, in aggregate, a great place for Western investors to put their money. No return in the equity market over 10 years as other markets have doubled and tripled, is kind of saying something. The other area we're concerned about is Macau. We think that the U.S. operators in Macau have an additional risk that's not being priced in, which is the fact that their concessions come up for negotiations next year, and they expire in mid-2022. And you look at a Wynn or a Las Vegas Sands, the majority of their cash flow at Wynn comes from the Macau concession. And if that were to be negotiated downwards, which is a real possibility, particularly if the trade wars continue, that would have a material effect on their cash flow and profits.
Yeah, we know things can turn on a dime when it comes to China and how policy is made. Kyle Bass, another noted China bear, is starting a new fund that will make all or nothing wagers on the Hong Kong dollar's peg. Do you see the Hong Kong dollar peg surviving the next couple of years?
We don't trade currencies. I'll defer that one to Kyle. He knows that world a lot better than I do.
All right. We talk a lot about your ability to spot financial fraud. I wonder if you can explain to me how you think companies are gaming the recovery and especially the stimulus that they're getting from the federal government, whether it's Congress, whether it's the Federal Reserve. I mean, in trying to figure out the next generation of corporate frauds, what are you looking for?
Yeah, I would suspect that there's probably, in light of the fact that the government announced it would crack down on usage of PPP,
Jim?
I think there's probably not a lot of that going on, and certainly not in public companies. In fact, the public companies that were going to get PPP were kind of shamed into, a lot of them, into declining it. So I'm not sure that the stimulus program is going to, in the public sector, is going to have a lot of instances of fraud. The question will be, obviously, how much of the stimulus is one time? Will it be renewed? But I think that strays away from the area of illegality. I think that's a policy issue. I think I've lost you, Scarlett, again. Oh.
Okay. Well, policy has made it so that companies are always it feels like, able to raise more capital when they need it. And the government really doesn't allow the cycle to turn over. What proportion of questionable behavior, fraudulent behavior can remain hidden when we're in an environment like this where companies can always raise more cash? So whatever frailties in their model don't get exposed.
Yep. It's a great question. And I'm giving a lecture tomorrow at our own Fraud Fest conference on the 300 years of financial market fraud and some recurring themes. And one of the themes of that is that the fraud cycle follows the business and financial cycle with a lag. So typically, as economic expansions go on and bull markets go on, people's sense of disbelief drops, and they begin to believe things that are too good to be true. And as you point out, companies with questionable business models can get funded. Look at Wirecard, got funded last year by an affiliate of SoftBank, which is an irony in and of itself, by the way. But and so people when they're making money hand over fist elsewhere begin to question things that kind of don't make sense to other people a lot less. And it's not till the markets generally turn down that people get a lot more conservative with their money and begin to question business models that they heretofore had sort of embraced. And so that's why you often see the waves of fraud being exposed after the cycle turns. So the question is people don't realize they're being defrauded until they want their money back. And so I think that wave of realization is still ahead of us, not behind us. The Wirecards and the Theranos is notwithstanding. But the cycle going on and easy money will make it easier for companies that are not playing by the rules to keep the game going for a while. And that was the case, by the way, in the late 90s. I mean, the last really big wave of corporate fraud was post the dot-com era with Enron and WorldCom and Tyco and others, America Online. And so where we saw the revelations and the public's kind of disgust at the revelations after people started losing money, once the NASDAQ started heading down in March of 2000.
Jim, final question to you. We talk a lot about the stimulus and how that forms a backdrop for the market environment right now. Do you think the Fed's stimulus picks winners and losers and promotes systemic inequality?
I think that the evidence is kind of pretty solid that disproportionate group of people, meaning wealthy people, are benefiting from the Fed's largesse. They own assets. I mean, it's not a surprise. And the people at the bottom of the economic ladder don't own a lot of financial assets. In fact, they're usually net debtors. And just one of the things I've commented on, and I'll leave it with this, is that I wish our central banks would pay as much attention to things like credit card rates as they do by maintaining asset prices. If they really want to help people and they can't enact policy on themselves, they certainly could push the banks on consumer credit card rates and others, as opposed to propping up bank stocks. So that'll be my only comment on that.
All right, Jim Chanos, thank you so much for a great conversation. Jim is founder and managing partner of Kinnikos Associates. Now, we'd like to hear from our audience on the overall investing environment with another poll. Please record your responses. Our question for you all is, will equity markets get more volatile in Q4? And the choices are yes, the storm is far from over, some, but not as severe as earlier this year. And finally, very little. Markets have priced in most scenarios. So please record your answers. And while those results come in, I want to hand things over to my colleague, Alex Steele. Alex?
All right. Thank you so much, Scarlett. I really appreciate it. Heads up, I can't control my 5-year-old in case we get a 5-year-old in the background as I work from home, but I do want to give you the results of the poll. So it looks like it's almost evenly split for the most part. About 52% say that you could see some volatility, but not as severe as earlier this year. But a close second is the storm is far from over, which sort of feeds into the narrative that not all the money is in the equity market, that we haven't priced for some kind of perfection. So it's a great segue to our next panel, sort of the equity and then also the credit conversation. Joining me now is Mary Erdos, CEO of JP Morgan Asset and Wealth Management. Also, I'd like to welcome Jim Zelter, co-president of Apollo Global Management. Guys, thanks so much for being here today. It's great to chat with you. Just Mary, just to touch on equities based on that conversation of volatility, I just wanted to get your take on sort of where the equity market is. Is risk appropriately priced in that asset? Oh, it looks like we're dealing with her connection. Okay, so hang on one second, Mary. We're going to fix your connection in just a second. So, Jim, actually, I'll just piggyback to you. In credit, where is risk priced in the credit market?
Well, good afternoon, Alex. And certainly we've been on a tremendous roller coaster ride the last 3 or 4 months. But when you just look at a couple of basic barometers, where leveraged loan and high yield spreads have been over the last 30 years or so, they've averaged right now, both U.S. and global high yield loans and bonds are in this 650 area spreads. And that's a little bit wider than the historical numbers, which would be in the mid fives, which I do think reflect a bit of risk in the environment, considering where we've been and the reacceleration of the consumer, and whether we are in a really a V-shaped recovery, an extended U or an L, which I know a lot of your panelists during the day on Bloomberg have talked about today. So, certainly we're off the bottom in terms of credit, and we've rallied quite a bit. But I think, again, if you look back at the historical numbers, we're a little bit wider than the historical indexes would tell one. And if you think about the relative risks that are confronted right now in the overall economy, that's not surprising.
So, Jim, what letter shape recovery then do you think we'll see versus what you think is priced into, say, the credit market?
Well, I think what you're really seeing in the last 30 days is the market saying that it's much more sophisticated than a V or U or L. And the reality is there's going to be a variety of companies in any one of those areas. Some companies that were very much focused on, retail, the day-to-day retail. As states open up, people are coming back, and those companies are going to show a bit of a V recovery. I would, on the extreme, whether it's business travel, high-end travel, or business travel, I think that's going to be a much more extended, L-shaped recovery, along with a variety of, consumer and behavioral changes. So, I think we were all trying to use blunt tools in the middle or the beginning of March in terms of appraising what type of risk. And I will tell you at Apollo, in terms of our overall platform, certainly we're probably on the more conservative view on when the aggregate demand comes back, which has an impact on unemployment and consumer spending. But certainly there are companies that are showing a V-like tendencies, but I don't think we're seeing that for the aggregate marketplace overall. So it's really it's very much an idiosyncratic bag, and I would say it's much more of a classic stock pickers market right now in credit in terms of understanding the dynamics of those two situations.
All right, Jim, we are joined by Mary. Mary, I'm glad our connection got restored here with you. So I don't know if you heard, but I was asking Jim about where risk is priced in the credit market and what kind of recovery is being priced in versus what he may see. So I just wanted to get your perspective specifically on the equity market, and then we can kind of move on from there, Mary.
Sure. Apologies. Hope this works a little bit better. I just want everybody to know that I'm so thankful you're doing this and that we're all getting back to conversations that are normal. And this one's live here from the branch. So we're thrilled with that being here. Our branches, by the way, have been open, most of them for the entire time. So people are still working really hard across the country to try and get this back to normal. And we are also working hard to make sure that clients are right-sized in the markets. And your question about the equity markets is the hardest one for everyone to answer. It seems surprisingly high, but we have never had this much stimulus in this short a period of time with interest rates at near zero levels. So when you put $6 trillion into the U.S. markets alone, $11 trillion around the outside rest of the world, you have markets that are reacting to that. And if you look back at 2008 and 2009, and you say to yourself, I wish I had put money to work in March of 2009 after the government stimulus had finally gotten itself to start to work its way through the system, you would have had a very nice and long ride in the market. So here we have it happening within a short couple of weeks for the stimulus to be announced, and then within a 3-month time period, the market has snapped back. So I think clients are trying to figure out, is this that the markets are pricing in advance of where we're going to be over the long term, or whether they're off sides. And I would just reiterate what others have said on the call earlier during your program, which is, markets are not emotional, investors are. Markets don't actually care about deaths, wars, tragedies, different racial issues that are happening in our country, all this sort of uncertainty of vaccines and pandemics and the like. Markets care about bottom line earnings, and they see through the short term into the medium and the long term. And the markets are telling us that the world will come back, that the U.S. in particular, and that the S&P 500 is a representative of very large and successful companies in the U.S., the majority of them, without digging into the comments that Jim was talking about, winners and losers, is really the most important thing that we'll do. So the markets have been taken up to levels that are reflecting just that, looking through to the medium and long term. And now the question is, if you've been in cash and you've been one of those people that have added to the $1 trillion of new money that have gone into short-term money market funds over the last 3 months, which by the way, it took us 3 months to add $1 trillion to these short-term money market funds. It took us a year to do it during the great financial crisis. So there's a lot of cash on the sidelines in addition to the government stimulus that's available, and we're gonna have to digest that as the markets feel, like they're trying to price that all in.
So, Jim, then to your world, when you're mentioning like winners and losers, and there is so much cash on the sidelines, why are you being cautious? Is that because the Fed in there, so it's going to extend the time until we get to that distress cycle? Like, what's the thesis behind that, Jim?
Well, I think credit is Mary and I both know, having been around for a few cycles, credit really is the lifeblood of the economy. And it all starts with credit. And that's why the Fed and Treasury were so diligent, and give them great credit for what they did. They had a playbook. They had the great financial crisis playbook of 08 and 09, and they executed wonderfully on that. I do think that we've been talking about the 3 phases of investment opportunity across credit. And I'll tell you from the Apollo playbook, we've talked about the three periods being, really the first is market dislocation, which we clearly saw for 3-4 weeks in March. Then the second stage is a stage of capital solutions, where companies all across the board need debt and equity solutions to tide them over 3 months, 6 months, 18 months, depending on the industry and the capital structure. And then the last phase is the distress stage, And now those 3 stages, which we've all seen over the last 12 weeks, we've participated in all 3 of them to different degrees. We've been on offense since day one. We've been very fortunate. Year to date, we've put about $50 billion to work. And at first it was that dislocation, those 3 weeks, which it was an amazing period for investment grade debt, great high yield and leveraged loan companies that had just been taken out to the woodshed, if you would. And then there's been a variety of capital solutions, whether it's Expedia or Albertsons or many other transactions that we collectively led. So, I think also this distressed angle, I would throw a little bit of wind of caution. I think I agree with Mary in terms of extraordinary, global monetary and fiscal response, 14, 15% of global GDP, unprecedented numbers. But that being said, and while we certainly are off the trough in terms of an economic recovery and we're back, businesses are opening, getting back from that par level January 1 or in March, we troughed at like 35 to 40% of activity. Getting back to par is going to take some time. And there's going to be some companies and some industries and some locations that are just going to be more challenging just because of consumer behavior. But it's been an extraordinary time, and again, the ability. Mary and I are both fortunate. We oversee big platforms that touch and see many things, but that's the Apollo perspective.
So we do have a question from an audience member joining us, Akash from Singapore, asking, Mary, this is for you. With the $11 trillion injected by central banks, when do you expect the impact of the liquidity injected by the central banks to start to wane? It's hard to even ask that question because you can't imagine a time where all of a sudden you're going to pare back on a QE or a corporate bond buying program, Mary.
Yeah, well, we're nowhere near that, and there's plenty of liquidity right now to fill the hole. As Jim was talking about, first you have to fill the hole, then you've got to get the flywheel of the economy going, and then you worry about the winners and losers after that. And it's very important that the amount of liquidity, there's been 505 central bank initiatives that have been announced just in the past 1 year alone, including things like this morning with the UK VAT tax and the like. So that's just the money that's already been announced, and there's plenty of time to go should things get worse. So I'm not worried about the stimulus. I'm worried about what stimulus does to bad companies that look like walking zombies, and that's really where Jim and Apollo are the ones that shine them so well in this environment. I remember post the great financial crisis, and it's hard to think back that when you went through 08 and 09, it was all a blur. And if you think back, you think, well, 09 was the bottom, so March of 09 would have been the time that you would buy distressed. And in fact, that's not at all the case. We invested a lot of money with Apollo, and the majority of that wasn't put to work until the beginning of 2010, as you went into 2011, 2012, because you have to be very patient with what stimulus does and then the after effects of finally sorting through the winners and the losers. So I think this cycle of distress, you have to have the liquidity, you have to be ready to seize the moment when it happens. And that's why so much of this money that has been put in cash and on the sidelines is being allocated to the experts in the distressed field. And they're ready to do that. And there have been opportunities, as we've seen over the past several months, all across different sectors, particularly in real estate and the like, where there's hung deals and other situations. But it's going to take a long time. And you want to be there, and you want to have patient capital that isn't required to follow an index and have to be invested at all times.
Well, and Jim, if I'm not mistaken, you guys have deployed about $50 billion during the crisis so far. So can you sort of thread the needle there between where you've been putting that money and then what Mary was talking about until we just don't know how it's going to shake out?
Sure. A vast majority has it, in terms of the Apollo deployment on offense, it really has been in credit. Now, we touch credit a lot of ways. We touch it in our insurance companies by being very active players in the investment grade market, which we were quite active in March and April as the wides. This is an asset class that was 100 over treasuries in January. It widened out to 350 over in March, really historic wides. And so we were quite active in offense on that. We were quite active on offense in the what I'd call the mainstream loan and high yield markets. There were a variety of companies that, whether it's a satellite company or a communications company, that obviously were affected by the macro, but weren't affected by the specifics of the environment. And we were quite active in that. As I mentioned earlier, we have a variety of vehicles that applied capital to great American companies like Expedia, like Albertsons, that were at different points. One, Expedia, an investment grade company that had a variety of withdrawals because of client withdrawals on travel. You had Albertsons that a great American company that the sponsors wanted to take public and really wanted to have a financing in place ahead of that. And so those were all credit. We obviously have taken some toehold investments in distress across the platform. But as Mary said, this is about patience. And our suspicion is throughout 20 and into 21, as the country grapples with, some degree of unemployment, a variety of consumer and behavioral changes, and certain industries that just take a longer period of time to get going, there will be those opportunities. But again, it's about breadth of platform and being patient. And again, I think what's different about today than 08. 08 was really about the residential problems, and really our banking system was having their issues. Today, banking system is strong as ever, fortress-like balance sheets, and the real issues are in commercial real estate, and really a lot of these consumer behavior and entertainment, travel, and lodging. And so, a lot needs to be, the consumer is a big part of our economy, 70% plus. So how those remnants and second and third derivatives will really have the trajectory for the next 12 to 24 months.
Mary, you're nodding.
Yeah, it's exactly right. I mean, the good companies from the bad companies is one of the most important things that we will all figure out. By the way, we should just add, it's also going to be the good municipalities and the bad municipalities, right? There's a bunch of stimulus that's also coming for local governments, and that will be good for the bad states, and it will also be good for the good states, but they won't have needed it, and they won't have been rewarded for having run their shops so efficiently. So there's a lot we're going to have to think about as we put that money to work. And I just think it's ever more important for people to think long term, make sure they've got the right asset allocation in mind, and make sure that they're not offsides in anything. The problem with any market environment like this that has the volatility that it's seen is that the gains don't feel as good as the losses feel bad, and it causes all sorts of emotional moves up and down. Jim Chanos was talking about all of the people that have gone into day trading and some of the online trading firms. I think that causes all sorts of complications for people. It is not a market you want to be trading like that in. You want professionals to think through the long term. And if you look, no one is having the conversation about active managers and can they make, more money for clients rather than index-like strategies today, because this is exactly why you need active management. You need active management in the public markets, and you certainly need active management in the private markets. And that's what you're seeing, which is that we're continuing to do the long-term, bottoms-up, fundamental research of is it a good company? Does it have good cash flows? And I'm discounting those back at a near 0% rate. So all of that is starting to look better, and that's what's being reflected in these markets.
Hey, Alex,
Jim,
I have a question for Mary.
Go ahead.
So Mary, you really have an unparalleled platform to which to see and understand what's going on in investors' minds. And in addition to the hoarding of cash or the savings of cash, what else would you see different in terms of your client base today? What questions are they asking you versus 08, 09, or any other cycles? We've both seen a few ourselves, but again, your perch is really unmatched out there. So I think the audience would love to hear about that.
I would say that I have been most surprised by the lack of panic. So the scenario that you go through in any crisis is, first, there's a flight to quality, which is normally short-term money market funds. In the last great financial crisis, that was what we spent a lot of time talking about, because that wasn't a solid footing in order to put money in until we shored up new regulations. This time it's fine. It's been very safe and secure. Then people start moving out the credit spectrum. They go into short-term bond funds. They go into high-yield funds. We've seen more inflows into high-yield ETFs year-to-date than we have in the past 13 years together. So there's just a lot of money. And by the way, it's coming from the short-term markets going up the credit curve. It's also coming from people in the equity markets wanting to not necessarily know where to navigate, so they're using the high-yield markets to do that. So it's becoming a very crowded market, but people are not panicked. The margin calls that happen, they happen in a very short window. We were running at about 1,000 a day. People had wherewithal to be able to cure them pretty quickly. Now you're seeing that in corporate financing. Very smart companies knew exactly what to do. They had the playbook from the great financial crisis. They didn't necessarily draw down on lines unnecessarily. They figured out how to get their financing in shape, and they've ridden through this. So I feel like we're in a very calm period. People are looking to put money into less liquid assets where they don't need to look at them on a daily mark-to-market basis. They can think about those for their long-term portfolios. That's in the sovereign wealth funds. That's in the wealthier individuals around the world. And they're ready and have enough liquidity that should we see something else, and that something else may not come from anything anybody's looking at today. It may not come from COVID. It may not come from racial tensions. It may not come from China trade war issues. It may come from something totally different, but the market is fragile, and just that little something may cause a wobble that people are not ready for unless we continue to have the stimulus that provides that cushion. And so the smarter money is really ready to take advantage of that. That's why Jim is seeing so many inflows into Apollo. That's why we're seeing so many inflows across our alternatives platform. of people saying, I got it, I want to have my money there, and then I want the professionals to be able to take advantage of it. And I'm not showing signs of panic.
Great insight, you guys. We have about a minute left, and I'm working from home. I'm assuming Jim is too, but Mary, you're clearly in the office, as you mentioned. So I wanted to get perspective on, like, are people coming back? Are you at like, when do you get to 100%? What's the work from home like? Tell me about it.
Well, at JP Morgan Chase, we have 250,000 people around the world that we quickly got to a work from home scenario. So thankfully, all the investments we had made in technology over the years made that quite simple and smooth. And so we had close to over 90% of the entire global population was in a work from home scenario. Certainly, different places around the world are going to return faster. Hong Kong hit a high of 39% on Friday of occupancy. They are ready for this. They have already lived through SARS. They know how to prepare themselves. Masks are a normal part of daily life in most public transportation and the like. So that seems to be working. Europe starts to open. Some pieces have been open. Some of our offices have been open all the way through in terms of trading desks and the like. But we have Milan, Spain, Geneva, Paris, other places opening up next Monday and then the following Monday. And then the US, where we've always had the branches functioning so that people can continue to manage their daily lives and small businesses and the like. They are starting to open more of the ones that were just drive-through only. They are starting to have the more fulsome team in. And the most important thing for JP Morgan Chase is that it is safe and secure, that people don't feel stressed about it. Re-entry for anybody that's been out of the workforce in any kind of a leave, a medical leave, a maternity leave, re-entry is a very stressful time period. We have to work through it slowly. It's going to be different in different places depending on how you transport yourself into the office and out of the office. Mm-hmm. And we're going to take that step by step. We're going to phase in and we're going to make sure that everybody feels comfortable. But people crave interaction with other people. And while Zoom is a fabulous technology for each of us to be able to do these things, Zoom is not spontaneous. And when you need that support from a colleague and you're trying to do very difficult lending decisions, M&A transactions and the like, it's just to the extent you can have some of it in person. And I think life will change a lot for a lot of the way people work, but you still need some of that. And so I think that's what we'll all be working through, and you'll see corporate America adjust accordingly, and I think we'll be in a better place for it.
Unfortunately, we do have to leave it there. I can't wait to work not in my living room. It was a real pleasure speaking to both of you. Thanks a lot, Jim Zelter and Mary Erdos. Thanks very much. I appreciate that. And coming up, stay with us because you'll have David Rubenstein join with Bill Ackman. So don't miss that conversation. That's coming up next.
So through the whole COVID-19 process, what have you learned about yourself and about your company that you didn't know before or were surprised to learn?
I would say the biggest thing we've learned is just that we can run the company entirely digitally. And running our first all hands was, we weren't sure whether or not we could do that. We didn't think we could have everybody working from home. But what I've seen as COVID-19 has really done is it's really accelerated our digital lives.
I think that this experience has shortened the learning curve for many, many people in how we will use technology in the future.
I was surprised at how quickly they could keep vehicle programs moving through the development process, doing it remotely.
In our company, we celebrate engineering, or we celebrate patents being issued, and we spend a lot of time with that. But you know what made us successful here was HR and the IT group.
Hello, I'm David Rubenstein. I'm here today with Bill Ackman, the noted investor and philanthropist and increasingly tennis player. So, Bill, thank you very much for joining us today.
Nice to see you.
Okay, Bill, the markets seem to be strange to somebody who's not following them quite the way that you do. The economy seems to be in a recession, a fairly deep recession, yet the market is almost where it was when we started this recession. Can you explain that, why the market seems to be so much higher than the economy is?
Sure. So, when people talk about the market, they talk about either the Dow or the S&P 500. And the S&P 500 is a market cap weighted index. And what's interesting or fortunate and unfortunate about the crisis is it affects different companies differently. And the more dominant large cap, companies, the stronger the balance sheet, the stronger the market position. Those businesses are huge beneficiaries of the crisis. And what the market does not reflect are small businesses, private companies, more levered businesses that don't have access to capital, don't have the same dominance as the public market. So a business like Amazon, which is a very big component of the market, is up 45%. That does a lot, obviously, for the averages. It's probably something approaching almost 10% of the S&P index today. My guess is 6-7 percentage points of the index. Businesses like Google, Facebook, I think long-term beneficiaries. And ultimately, the value of a business is the present value of the cash it generates over its life. And even if the cash flows are disrupted in the short term, if they're greater in the long term, the values will be higher. So I think the stock market is a snapshot of a portion of the economy. If you had an index of smaller businesses, the market would be down 50, 60, 70, 80%.
So the market also seems to gyrate more than normally. We have market going up 1,000 points, down 1,000 points. Is that because of computerized trading, or why is the market gyrating so much?
Again, the market is a discounting mechanism, and people's estimates of the future have been very volatile. How long is the crisis going to go on for? When will we get back to our normal life? These things affect the input of the model that analysts are using to value securities. I think the other issue is the market in the short term is very much a sentiment index. It's a way for people to express their emotions. And there's been a lot of emotions in the short term. And when that happens, there's a corresponding degree of volatility. But I don't think the market is dramatically wrong. When you look at the market on a company by company basis, when we look at the companies we own, different businesses have been affected differently. Many businesses will be long-term beneficiaries.
Not long ago, you made a very spectacular investment. As I remember it was $27 million you put on a hedge, in effect, and it became worth more or less $2.6 billion, something like that, about 100 times your money. So I don't know if you've done a lot of those 100 times your money deals, but was that something that you expected that would go up that much? And you were later criticized by some for having gone on CNBC and kind of talked down the market at the time when you had a short position. Can you explain why you made the investment and why the criticism might not have been fair?
Sure. So what we did is we bet that credit spreads would widen, which I thought was a very, very low risk bet in the sense that credit spreads were at the all-time tightest levels ever, going into what I thought would be a pretty serious economic crisis. If we were wrong about the economic impact of the crisis, we would have paid, again, a relatively modest amount of premium, to be wrong. So it was a very asymmetric bet, and unfortunately, things played out the way we expected in terms of the economic impact of the crisis. If you actually watch my CNBC segment, all 28 minutes of it, which I think a lot of people didn't do, as opposed to the snippets that CNBC advertised after my presentation, I actually gave where I said, well, look, we're at a fork in the road. If we go down one fork, it's doom and damnation. And that fork was a one in which we did not, in effect, shut down the country briefly and carefully reopen the country. If we went down, just let the virus go roughshod, I felt it would have very dramatic economic and health implications. That was the part I was most concerned about. But as I said in my 28-minute presentation, that I was actually quite bullish because I was very confident that the government would, in effect, shut down the country, and that would stunt the growth of the virus, allow us to reopen the economy. And what I said on CNBC, that's why I'm buying stocks. And we went bullish. We were very, very bearish going into March 12th. And on the 12th, we started buying stocks very aggressively, and we started unwinding our hedge as quickly as possible. I went on CNBC on the 18th. By the 18th, I had 3.3 billion more exposure than I did on the 12th. And I was really, in a way, I was talking my book, and my book was bullish. I was betting that the country would be shut down. And fortunately, I think for the country, California initiated the shutdown within 24 hours, and then New York State, and then the rest of the states have largely followed. And that's why you're going to have the opportunity for an economic recovery, and the virus will kill, only 150,000 people instead of, what could have been millions. But the unfortunate part is the CNBC ran 30-second segments where I talked about the fork in the road of doom and damnation, and they didn't run the segments where I was saying, actually, I'm bullish. So if you go back and watch, you'll come away with a very different impression than some people perceive based on short snippets.
Well, do you have any more 100 times your money bets that you might be able to give to us, where somebody might be able to make 100 times their money in the not too distant future? Any good bets you might recommend?
Sure. So it's a bit of an overstatement to say, we ended up, spending $27 million on the insurance policy on which we collected $2.6 billion. But we had to, the way that bet is entered into is you commit to pay $500 million per year for 5 years. And the longer you keep it on, the more you can lose. So it's a little bit different than someone who can scrape together, $10,000 and make 100 times. So it's a bit of an overstatement to say we made 100 times, but it was a very good hedge, and we were able to invest the money in the market and protect our investors' capital. So we felt good about it.
Okay, so let's say, Bill, I told you today with absolute certainty, no doubt about it, that the next president of the United States would be Donald Trump. He's going to be reelected. You know for certain. Would you short the market? Would you go long the market? What would you do?
It really wouldn't change anything that we're doing. Our strategy is to buy super high quality, dominant companies that can withstand a pandemic or a dramatic movement in interest rates that are not particularly exposed to the economy. So who the president is, it's not something that we would make a bet one way or another on the portfolio.
Okay. The same thing would be true of Biden. If I told you with certainty he's going to be the next president, you wouldn't change your views, right?
No.
Okay. So you are what's called an activist investor, not a macro investor. An activist investor typically invests in companies or makes specific bets on companies, the direction up or down and so forth. How did you get into being an activist investor as opposed to, let's say, a value investor, a macro investor? Was it something you decided to do while you were in college or early in your professional career? What led you into that route?
I think it's part of my personality. I started as an investor. I raised the first pool of capital when I was 26. And I made an early investment in a company called Rockefeller Center Properties. And I saw management making a series of decisions that made no sense to me. And it was just so obvious the right thing to do as to how to create value. And it was being a frustrated passive investor that made me into an active investor. And that investment turned into a very profitable and very high profile investment. And with success, one is motivated to try it again. And it's been helpful to the strategy over a very long period of time. And it's fun. And if you're passive, you can feel like the market's patsy. And if you're active, you can actually create some value. And I think it's a lot more interesting than just picking securities. We bought a stake in Chipotle at a time where the company was struggling a few years ago. We put a few directors on the board. We recruited a new CEO named Brian Nickel. It's completely turned around the company. The stock has, almost tripled in the midst of a crisis. And it just tells you that, that's a lot more fun and it's a lot more profitable. And it's, I would say, a lot more good for America than just simply being a passive stock picker.
So Pershing Square was started in 2004, your current vehicle. Where did you get the name Pershing Square?
Sure. So right in front of Grand Central Station used to be a square that was an open grass, sort of public gathering space. Over time, Grand Central Station was built. There's that little bridge over it, but it's that location is still called Pershing Square, and our offices were at the corner of right in front there, 110 East 42nd Street. So I liked the name, and it was available. So that's what led to our choosing it.
You started in 2004, Pershing Square, with I think $54 million. So if somebody had invested in 2004, part of that $54 million, and they kept it with you, what kind of compounded rate of return would they have today?
You would have about 11 times your money and about a 16% IRR.
Okay. And are there people that have done that kept their money there the whole time?
Yes, the very loyal ones. It's not been a straight line up, to be clear.
Okay. So let's talk about, for a moment, some of the campaigns you've done as activists. Some of them have worked out, some have not. Chipotle seems to have worked out. But you did a couple that were difficult ones, so Herbalife or Valiant. They didn't work out. What would you say is the mistake you made in hindsight and that you would try to avoid in the future?
Sure. So there's sort of 8 principles that have driven our investment success. And when we have veered from those 8 principles, we've lost money. And after we went through a very difficult period, circa 2015, 2016, the 2 investments you mentioned were big drivers of that. It was, if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engraved them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy. It sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to, our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times, there's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed from an investment standpoint.
To be an activist investor, my impression is you have to be a fairly tough person. You can't be a shy, retiring person because people are going to criticize you. So did you develop a thick skin relatively early? And do you feel okay being confrontational at times, or is that a problem because you're just not your personality?
Sure, I'm generally not a confrontational person. I had my one little episode with Carl Icahn on CNBC that had got a fair amount of attention. I didn't actually choose to debate Carl Icahn on television. To the credit of the network, they brought him on in the middle of an interview like this one, where we both had an opposing point of view. On an investment, I do think it's a strategy that requires a thick skin. But I think anyone who takes high-profile positions, not just on investments, but on any issue, particularly at this moment in history, is going to get slammed by one side of the debate. It's the inherent nature of a divisive country, and fairly strong opinions on both sides. But I've always had the view that if you take a public strong position that you have a lot of conviction in, you're guaranteed, and no one pays attention, then maybe there isn't that much substance to what you have to say. So I guess I take it as favorable and can also often be instructive to hear the opposing point of view, as long as it's not an ad hominem criticism. I have no objection to someone taking the opposing point of view at all.
Let's talk about the economy for a moment. Right now, it seems as if we borrowed an enormous amount of money to pay for the recession, in effect. The Fed has put up maybe $4 to $6 trillion off its balance sheet. Congress has maybe put up so far $3+ trillion, maybe close to $4 trillion. So are you worried about the debt having an impact on the economy in terms of the value of the dollar, inflation, or just the size of the debt and our ability to pay it off?
Sure. So, if you think about the country as a business, the country has a lot of intrinsic value, a lot of asset value. I would say one of the most valuable assets of the country is the country owns 35% of your income and my income. In a way, you can think about that. That's the current level of taxation, federal taxation. So that's, in effect, the country owns a 35% stake in your intrinsic value and my intrinsic value as a contributor to the economy, and the country retains the right to change that percentage ownership at its will by in fact changing, obviously tax policy. So there is, then of course we have enormous assets, whether they're real estate assets or infrastructure assets. That are, so I think the asset side of the U.S. balance sheet is very, very large. Obviously, you'd never want to let the liability side of the balance sheet grow too much. And there are a lot of not just debt liabilities we have outstanding, but we have, Social Security, the enormous healthcare costs, Medicare, Medicaid, et cetera, that we bear as a country. So it's something that is concerning. We are fortunate finding ourselves in a very low interest rate environment, but it's something to think about and be concerned about, but it's sort of difficult to do the same kind of calculation of the leverage nature of the United States unless you do a proper valuation of the asset side of the balance sheet.
So we're in a technical recession. We're technically in a recession, I should say, and it's fairly deep. But right now, when do you think we're likely to come out of this recession? In the third quarter, fourth quarter, next year? Do you have any views?
Yeah, I think we're going to begin a recovery, certainly by year end. I don't think we'll be back to anything close to a normal economy until probably the second half of 2021. I think if we have an early vaccine, Pfizer's been talking about a potential distributable vaccine by the fall, that will obviously make an enormous difference. I think if we can reduce the treatment of the virus to, want a test you can take at home and get an accurate result in 15 minutes. And it's telemedicine to your doctor to get, for the doctor to say, okay, you need a prescription for remdesivir in a inhaler format, and you can stay home for 2 weeks and be fine. Those things will make a fairly significant, positive impact. But I think we've had kind of a sloppy closure of the country for the virus, and we're having a bit of a sloppy opening. So I think you're not going to have business confidence return and consumer confidence return until the kind of people feel safe, truly safe. If I had to guess, that's really more like the second half of next year, and into the beginnings in Q4 and Q1 and Q2 of next year.
You've said sloppy opening. What you mean is there's a lot of cases in Texas and Florida of people getting virus now, and it doesn't seem like it's disappeared. So are you worried that this could, without a vaccine, keep going on for all of 21?
I think what will happen is, the healthcare system is getting better and better at treating the virus. So, they're learning when to put people on a ventilator, more importantly, when not to. They're learning which drugs can have a positive effect, and learning more about what doses and earlier, when to give the medication. Testing is improving. And I think all of these things are positives and will improve confidence and reduce, kind of risk. Things will be a lot better, I think, in a few months, although you're going to have some states with a lot more cases because people have not been careful, and those states are going to have to moderate economic activity and maybe, go to a mode of protecting more aggressively, people at risk and being more cautious, again, all of things which will temper the economic recovery. But I do see a, kind of gradual improvement in all fronts as the global healthcare system, every medical researcher in the world basically working on solving one problem and a lot of resources going into it. So I think by the fall, we'll feel a lot better if we can take death off the table. If we can take severe illness off the table, I think that's certainly possible in this calendar year. People are going to feel a lot better about living and going out and living a more normal life.
So if Jay Powell called you tomorrow and said, look, I'm not sure what I should do. Should I do more? And if the Secretary of Treasury, Steve Mnuchin, called you tomorrow, should I pass another bill working with Congress? What would you tell both of them? Would you say we need more help from the Fed, we need more help from Congress, or would you say we've had enough help?
Look, I think we have to protect the most vulnerable people economically during this period of time, and I don't know when do these programs precisely run out. You need to design programs. I've heard, and we've made a lot of investments in the restaurant industry, where some of the benefits are at a level where they're better than $15 per hour, sort of the minimum entry points for many private businesses, and it discourages people returning to work. So you need to design them in such a way that you don't reduce economic incentives to return to work, but you have to have them large enough to protect people during one of the more challenging times, particularly for people at the lower end of the economic scale.
Now, you mentioned earlier that tech companies seem to have done pretty well. Your firm seems to invest more in, let's say, consumer retail, or at least some of the visible ones are in that area. Are you a tech investor in the sense of investing in tech companies, or is that something you plan to do in the future, or you wish you had done more of?
Sure. So look, there are always investments I would rather not have missed. I feel like I could have figured out Amazon, but that's a backward-looking sort of approach. But I don't think Amazon so much as a technology company. In the same way, Starbucks is in a way a technology company. One of its competitive advantages versus the corner coffee shop is its digital ordering and delivery and contactless way of interacting with customers. I think every business is a technology company. What we are not is we're not investors in pure technology companies. We wouldn't invest in a self-driving company with no revenues, but we might invest in many of the businesses we own are heavy users of technology, whether they're consumer facing or whether they're industrial companies or manufacturing businesses. We're looking for businesses with very attractive economic characteristics. There are many so-called companies that are in the NASDAQ. People think of them as tech companies, but they have the kind of economic characteristics we like. We just don't like businesses where a couple of young people in a garage, somewhere in Silicon Valley can come up with a disrupting technology that disintermediates the business.
Suppose a young person at your alma mater, Harvard, or any other college said, look, I'm watching Bill Ackman. He's a smart guy. He's making some money. I'd like to do that. I want to be hired by Bill Ackman. What do you look for when you're trying to hire young people? You want somebody that's exactly like you? What are the skills that you're looking for?
So we're really a private equity firm that invests only in the public markets. And so when we've recruited for the investment team, if that's what you're referring to, we're looking for people, the typical candidate spent a couple of years in investment banking, in a great training program at a big firm, a Goldman Sachs, et cetera. Blackstone, or the old version of Blackstone, their Blackstone advisory business. We've recruited some people from there. And then, several years in private equity, because private equity investors focus on simple, predictable, free cash flow generative businesses and focus on businesses that can support a large amount of debt and really determine valuation, think about industry dynamics. So we're looking for someone with, that kind of a background, usually 4 or 5 years out of school. And then they join the team, and we've had a lot of continuity and duration for people who have come to the firm. But we hire very, very few people. We only have a 7-person investment team. The plan is to keep it quite small.
Well, when you had your problems a couple of years ago, you alluded to, and I talked about Valiant, and for example, did you ever lose faith that you would be able to turn your business around? And did you ever doubt that you could make this a successful business again?
Sure. So, I think I've always liked to say that success is not a straight line up. And I would give these talks at business schools about how to deal with failure. And then I failed. And then I had to implement the strategy that I was a proponent of to business school students. But I think the key, look, we have a business with a strategy that makes sense. We made some mistakes. Experience is learning from those mistakes. That's the key. And then, I was quite confident that if we adhered to the principles that built the success of the firm, or re-adhered, if you will, that we return to success. And it's a question of duration and every day coming into the office and making decisions with good judgment and being level-headed. And, with time, I was confident that things would recover and feel very fortunate that things have worked out the way that we expected. But I'm certainly going to be, now at 54, I'm done making mistakes. So that's my business plan going forward. We're going to be very, very watchful about veering from the course that has led to our success.
In recent months, you've been running your company, I assume, from your home, I assume. And has that made it more difficult or easier? And what have you learned from this experience? You think you can run the company from your home in the future, just like you're doing it now?
We could, but it's far less fun. And that, one of the reasons why we can run the company from our respective homes is that we built a real culture and almost a family-like environment among the people, and a culture of trust and respect. And, we all like each other. But we can succeed doing this because we view it as a temporary solution. I would say, we've been incredibly effective and incredibly productive, working from home. But it's harder to have the separation between your job and your life. If I think it's actually very, very helpful to come into an office, and then when you leave it behind you. It's a lot harder. I'm working from the den where my office is located. My parents' bedroom is, sort of over there. The baby, sometimes I hear her crying in the kitchen, so it's quite beautiful in a way, this moment with, living with my parents for the last almost 4 months, and I have a 13-month-old child. I've gotten remarried relatively recently. I'm very fortunate to have beautiful family, but it works from a temporary standpoint. And I also think it will be easier if I have a day where I need to focus on family, where I can operate from home, and that's true for other employees. So I think we can get to a model that's better than what we had, but it's going to be centered around an office environment.
Now, in recent years, you've become a very active philanthropist. You've signed the Giving Pledge. You're involved in the Giving Pledge effort. What are the areas that are your greatest passion in philanthropy?
So, I like the inherent leverage of an asymmetric risk reward in business, and I like the same thing in philanthropy. So we've done a lot of investments in what I would describe as early stage businesses that are designed to address social problems. Many of them are nonprofits. Many of them are actually, a B corporation or a for-profit or something in between. And we've had some Google-like outcomes where we've, bet with an organization very, very early, an organization, the organization with a budget of 100,000 or 300,000, and we give them $3 million at a very early stage of their development, and now they've become organizations that really move the needle. So I find that stuff very sort of, I'm passionate about that kind of structure. But, in terms of what we focused on, economic empowerment, social justice, addressing income inequality, we've done some cancer research, kind of backing kind of early, sort of younger scientists before they can get grants from the NIH. It's really been about backing very talented, I would say, entrepreneurs and people who are passionate about solving a problem with either a for-profit solution or a not-for-profit solution. And I'm even more passionate about the for-profit solutions to a problem. Not that we're trying to make a profit, but that we're building a sustainable organization that can address a problem that doesn't need to constantly rely on an annual grant from a foundation.
I mentioned at the beginning that you're a tennis player. You didn't play in college, but you've taken up tennis recently. I think you're pretty well regarded as a tennis player. Do you wish you had played tennis earlier? And if so, do you think you could have been a professional tennis player?
So I played in high school. I was a good state level player. I was told by the Harvard coach that I had a good chance of making the JV, and he told that to about 50 other young people. And there were probably 4 spots on the JV, and the rowing meeting was across the hall. And about 15 minutes into the tennis meeting, when I saw how many people were there, I went across the hall to the rowing meeting. I ended up rowing for 4 years, and it had a profound impact on my life and my ability. Actually, you asked me the question, how do you get through a difficult business period? The answer is it helps to be a rower and endure a severe amount of physical, mental torture, which was a big part of rowing. So I have no regrets. Although the last 15 years I've taken up tennis, and I'm a vastly superior tennis player. I can play a very high level tennis game, much better than I was, when I went to college. So I think I had the best of both worlds. Feel very fortunate.
So I've told you've played with John McEnroe. Can you beat John McEnroe? He's a little bit older than you, or not quite yet there?
I played with John McEnroe about 12 years ago. I had kind of a funny incident where we were playing doubles, and it was for a charity, and I hit an overhead, and I hit him with the overhead. I can't think on probably twice in my life I've hit someone with an overhead. He spent the entire rest of the match doing his best to hit me back, which really gives you and by the way, I have a lot of respect for John McEnroe and his personality, but it was a fun moment. I think it's extremely improbable that I could beat John McEnroe in a singles game, but with an equal partner I would give him a good run in the doubles. But yeah, one of the greatest players ever, and I really enjoy playing with him, and we win a few games and hopefully more.
All right. Well, I hope you get to play again with him, and I want to thank you for taking time to be with us today. And I hope you can find a couple more or less 100 times your money bets, though I realize it wasn't quite 100 times your money, but it was pretty successful. Thanks a lot, Bill.
Thank you so much, David. Appreciate it.
Bye.
Bye.
Hi, everyone. I'm Shortia Brantley, Deputy New York Bureau Chief and Bloomberg Live Senior Editor. COVID-19 and its disproportionate impact on African Americans, as well as the recent unrest after the killing of George Floyd by 4 Minneapolis police officers, have laid bare the racial and economic inequalities that persist throughout the U.S. So what can we do to close these economic gaps? Let's discuss with Ariel Investments founder, chairman, co-CEO, and chief investment officer, John Rogers. Welcome, John.
It's good to be here.
Great. Thank you for joining us. John, before we dive into economic inequality, what is your take on the historical significance of the past few months, from COVID to millions of job losses to the killings of Ahmaud Arbery, Breonna Taylor, and George Floyd, and the protests that have followed?
Well, it's been an extraordinarily difficult, heartbreaking time. And, to see so many people lose their jobs, to see the markets collapse the way they did, it's just been remarkable. I think it must be very much like 1968 when we had all the horrible riots after Dr. King's death. And then, of course, when we got into what happened with Bobby Kennedy, and that whole year was just so extraordinarily, heartbreaking for our country. This is a similar type of a period for us. When you put together the COVID and the race issues, none of us are resting. None of us are relaxed. There's just stress everywhere.
interesting similarities to 1968, a very hot year, regarding the assassinations and unrest. But does this feel different in terms of any change that we may see from this? Will the change, is it fleeting or is it sustainable?
I'm hopeful this is going to be sustainable for a couple of reasons. I'm having lots of great conversations with many CEOs from companies that we've invested in to CEOs of the boards that I'm on and that Melody Hobson is on. And we're hearing that they're really serious about change and asking for advice, asking for counsel, and truly listening, which is something that is unique this time. The other thing that's really important, Congress right now is the most progressive Congress we've had in our nation's history. And we have people like Joyce Beatty chairing the subcommittee on diversity and inclusion for the Financial Services Committee. You have Maxine Waters chairing the Financial Services Committee. They both have excellent staffs, talented people. It gives me hope that they're going to be able to take this environment and change lives and change opportunities for African Americans from an economic justice perspective, because that's what often gets lost. Social justice is important, but it's tied also to economic justice.
Definitely. And let's talk about the wealth gap. So the median net worth of a white family is about $171,000. For a Black family, it's about $17,000, so about a tenth for a Black family, according to the Federal Reserve. What does multi-generational wealth and the role of multi-generational wealth, what role does that play in these numbers when we look at net worth?
Multi-generational wealth in this country, we've been going backwards the last 40 years or so. That is one of the key things that I think that people really don't understand, is how much worse it is for African Americans than we were 40 years ago. So we've got to figure out a way to make a dent in that problem. And the way that I think we have to do it is we have to have more Black business leaders in corporate America, but we also have to have more Black successful African American entrepreneurs. Because growing up here in Chicago, when we had George Johnson running Afro Sheen and Ultra Sheen and John Johnson running Ebony and Jet magazine, they were role models for folks. They hired hundreds, if not thousands of people. They created enormous philanthropy for our community and political empowerment for our community. We have to go back. If we want to get multi-generational wealth, we've got to have more Black business leaders and more Black successful entrepreneurs of scale.
Do you attribute to the lack of Black executives in the C-suite? I mean, for example, we only have 4 Black men serving as CEOs of Fortune 500 companies and not a single Black woman. So how do we begin to enter those spaces?
Well, I think it's a couple things. One, if you have successful African-American business leaders and entrepreneurs, the next generation of Black business leaders will come along after them. It's interesting. George Johnson's son, Eric, runs the largest Black company in Chicago that's a supplier to McDonald's. So decisions that were made to create opportunities for entrepreneurs a generation ago have brought together a new generation of successful entrepreneurs. That's something that's important. But it's also critically important that we get African Americans who are on corporate boards and progressive leaders that are on corporate boards to hold their management teams accountable for diversity and inclusion. Tie it directly to their pay, have a Rooney rule when it comes to hiring, and make sure that when you're in that boardroom, you're confident and comfortable bringing up social justice and economic justice issues when you're in the boardroom. The civil rights agenda often gets left out if you're not courageous enough to go out and speak truth to power and tell the leadership of these corporations that they have to live up to the commitments they've made around diversity and inclusion, not just talk a good game, but really execute.
Now, I know you've been very vocal about this, but is the onus on Black executives to be that voice on corporate boards when there are already so few of us on those corporate boards?
Well, it's just critical. We started a conference 17 years ago with my friend Charles Tribbett from Russell Reynolds, and Deloitte's become our partner. And this last year, we had 200 directors come together. We've had everyone from President Obama and Don Thompson to Jeff Immelt and Jamie Dimon, and from George Lucas to Shonda Rhimes. We've had just extraordinary people come and speak. But most importantly, every year we have what we call the conscience of the conference. Harry Belafonte, John Lewis, Andy Young, Reverend Jackson, Reverend Sharpton, people who actually have dedicated their lives to social justice and economic justice. And they're there to remind all of us that are fortunate to be in the boardroom of the sacrifices that went from prior generations who sacrificed their lives and risked everything to get these doors open for us. And the commitment that they expect of all of us to get in there and fight and fight and fight and speak up, even when you're the only one in the room, even when it's uncomfortable to do, when you see what the kind of risk that John Lewis took, and getting his head bashed in, marching, we realize that we as African Americans on corporate boards have a responsibility to speak up and make a difference.
Mm-hmm. So, according to the Alliance for Board Diversity, white women have been the biggest beneficiary when it comes to additional board seats. So what can businesses and corporations do to ensure that their boards are more reflective of society? Why is it that, it's so much easier to champion gender diversity when it comes from a lot of our leaders instead of racial diversity? And why is race still that third rail in this country?
Well, I think race is the third rail because of the way that we came to this country. Is we know what's happened over the last 400 years. We've experienced the Jim Crow rules. We saw that whenever we get a little bit of progress, we get sort of knocked back again. My great-grandfather had an extraordinary hotel in Tulsa that was burned down during the Tulsa race riots. So there's this long history where people have not been supportive of African Americans, that we've tried to move ahead and get ahead and bring our communities together in a positive way. There's a lot of studies that you're well aware of around implicit bias and unconscious bias. Too many of the programs talk about supplier diversity, and they think that African Americans can do only the construction, the catering, which are very important businesses, but not giving us an opportunity to participate in the parts of the economy where the wealth's being created today, in finance, in professional services, in technology. That's where the wealth and opportunity is. And those are the areas where we're the least involved and least included. And I think a lot of it is because of this unconscious bias and implicit bias that's still so much a part of our society. And we've got to fight it. We've got to change it. We've got to show people that once we're on the playing field, we're going to outperform. And as Reverend Jackson always says, baseball became a better sport once Jackie Robinson started playing and Ernie Banks and Willie Mays followed suit. Well, the same thing is happening with us here in business. Once we're allowed to get on the playing field, we'll show the world that we can deliver excellence in everything that we do. We have the talent and the gift and the depth to really make a difference for all of us. And our country will be stronger because of that.
Definitely. You hit on implicit bias. What are some of the other factors, specifically within the financial services sector and technology and other professional services, that are preventing Black leaders from ascending to the C-suite or even getting the funding if they've decided to venture on their own, also getting access to capital to fund these startups?
Yeah. I think that, access to capital is helpful, but to make it in professional services or financial services, you need customers. I started my career as a stockbroker, a financial advisor at William Blair. I was the first African-American professional to work there. And I pretty quickly noticed that all of my friends that were also stockbrokers and financial advisors, they had relationships, multi-generational relationships with people who live in the North Shore or the Western suburbs. They had aunts and uncles who were CFOs and CEOs and general counsels of big corporations. So they were able to bring in business, generate revenue, and grow their companies. Because of the segregation in Chicago, growing up in the south side of Chicago like I did, I didn't have those kind of relationships. I didn't have dozens of people that I could call on to help generate revenue as I was making my way at William Blair. I saw the same thing with my mom. My mom was the first African-American woman to graduate from the University of Chicago Law School. And she would get asked to serve on all types of boards, be involved in this and be involved in that, get an honorary degree here, get an honorary degree there. But when she would ask the same white men who wanted her in the boardroom, they'd say, I'd like to be your lawyer. I'd like to generate revenue by practicing law with my skills. They said, no, that's not the right thing. You should be comfortable just being in the boardroom. And that's still a challenge. We have to generate revenue. We need access to customers if we're going to build our businesses in professional services and financial services.
So, in that vein, then, what are some of the steps? What is the role of the federal government in this? What is the role of prominent businesses and industries such as private equity to ensure that we're seeing more opportunities for people of color?
Well, if you think about it from the private equity standpoint, private equity success stories, they serve on all the boards around the country, corporate boards, university boards, hospital boards, nonprofit boards. They need to be able to say, if we want to have African Americans be successful, all these institutions that they're on the board of need to be doing business with Black businesses. That's a critical role that private equity people can do. They control hundreds of companies, control hundreds of boards. They can make a difference by fighting for us in that way. The other thing, when you bring up government, the federal government has large pools of assets. The PBGC, the National Railroad Trust, the Smithsonian, the Kennedy Center. There's lots of places there where the federal government can push those institutions to do business with Black firms outside of just supplier diversity, to do it in what the University of Chicago calls business diversity and include us in everything they spend money on. And it's basically going back to the way things used to be when we had progressive mayors like Maynard Jackson in Atlanta, who's one of my heroes, Harold Washington here in Chicago, Coleman Young in Detroit. They not only insisted that Black businesses have a chance, but they also pushed all their professional services providers, their investment bankers, their lawyers, their accountants, to have Black partners on the relationships with the business that their respective cities were doing. If everyone did that, we would have a virtuous circle. And we would all be able to rise together, all be on the playing field together, bringing our skills and talents to make our country and our cities stronger. So I often say we need to go back to the future and then, again, support the dynamic progressive leaders today that seem to be really getting it, like Congresswoman Beatty and others that I mentioned earlier.
Mm-hmm. Now, you just talked about the purchasing P. You also discussed two other Ps, people and philanthropy. Can you explain their role in also closing the economic gaps that we see today?
It goes without saying, and a lot of corporations are doing an excellent job of that. They're starting to understand that they need to give more of their philanthropic dollars to civil rights organizations that care about not only social justice, but economic justice. National Urban League, Rainbow Push, National Action Network, all of those giant organizations that make such a difference for our communities. So I think they're getting the philanthropy. On the people side, we just have to make sure that we're doing a much, much better job of holding managements accountable for the lack of diversity in the C-suite. And you have to tie compensation to it. There are some places that do a great job of that. Northern Trust Bank here in Chicago, Regions Bank. You have Exelon Corporation, McDonald's are doing an excellent job of really making sure that they're bringing diversity into the largest levels of their organization. So I know kind of my hometown who's doing it the best, and I'm sure I'm missing somebody, but we have to celebrate those companies and those leaders that are willing to make a difference. And then we have to challenge those that are not making a difference.
Now, before we go, I just want to touch back on Black Wall Street, and you mentioned your grandfather, J.B. Stratford. Can we recreate Black Wall Street today in this country, in today's economy?
I think we can. If we get our anchor institutions to celebrate Black business leaders and work with Black businesses, as I've been mentioning today in this interview. So if you think about it, just think of Tulsa. If all the anchor institutions in Tulsa made the commitment to work with Black businesses in Tulsa and work with the descendants of the Black Wall Street massacre, you would have large Black law firms, large Black accounting firms, consulting firms, advertising agencies, public relations firms, money management firms, private equity firms. You would have a virtuous circle of success. Every city can do that. If the anchor institutions, the corporate leaders, the hospitals, the museums, and the universities push everyone to do business with each other the way our progressive mayors used to 40 years ago. We can do it. We can do it together. We want to include everybody. And as Dr. King said, many white Americans of goodwill deplore prejudice, but they accept economic injustice. That's what we have to fight for. We have to fight for economic justice in our capitalist democracy here in this country.
Before we go, I just want to ask you personally, you talk about speaking out. Are Are you concerned that this could potentially impact inflows into your funds? That you've been so vocal about the disparities and what's happening in our society today.
Well, I think we at our firm, at Ariel, Melody and I believe deeply that we have a responsibility to fight this good fight. We've been very, very fortunate in our lives to be in the boardrooms, to be in these leadership roles, to see the amount of wealth that's created in professional services and financial services and technology. So we've been given this gift. We've been blessed to be in these boardrooms, in these leadership roles, and to see how our economy's evolved and realizing that our community has not been able to fully participate. And again, having heroes like Maynard Jackson and John Lewis, Bobby Kennedy, Dr. King, Reverend Jackson, and others, we have those kind of role models who took so much risk in their lives. It just is, for us, it's clear this is the right thing to do. And by being the first African-American money management and mutual fund company in the country's history, we think, again, we have a special responsibility to push these issues and get them out on the table and do it in a way that hopefully we can make a difference for our community.
Thank you so much, John. We'll have to leave it there, but thank you so much for your time today.
This has been terrific. Thank you.
Thank you. All right, everyone. That was John Rogers, Ariel Investments Chairman, co-founder, Chairman, founder, co-CEO, and Chief Investment Officer. I just want to say thanks so much to all of you for joining us today for our first Invest Global Day 1. We hope you enjoyed these discussions, and thanks again to all of our speakers. I also want to thank our founding U.S. sponsor, Invesco QQQ, for helping to make this event possible. Invest Global returns tomorrow at 1 p.m. local time in Hong Kong, followed by virtual events in Dubai, London, and New York. Each event begins at 1 p.m. local time. You can view all of these sessions from around the globe here, along with recap videos, Bloomberg intelligence data, and resources from our sponsors. You can follow us at Bloomberg Live on Twitter and LinkedIn for updates. And please follow ongoing financial and markets coverage at Business and on Bloomberg.com. If you haven't already, please consider subscribing to Bloomberg.com/subscriptions